Finance podcast, where I sit down with finance industry leaders and professionals who are doing really interesting things in their spaces and hear their story of how they've built their career and what they're doing now in finance and what are some of the emerging trends. Today, I'm really excited to have Jonathan Nurick from DivGro. And Jonathan, I'd love to start by just asking kind of how did you get to where you are now, working in DivGro? Where did your career start?
Well, firstly, thanks for having me on the podcast. Great to be here, Dan. I started out first as a lawyer in the area of tax law, then went into investment banking and ultimately into our family office. And the career trajectory, in a sense, starting in law, it wasn't really the right fit for me because I struggled with the concept of a time-based productivity where every hour was somehow benchmarked to some kind of degree of output. And first in law and then also in investment banking, I found there was like a strong push towards extreme specialization. It was kind of like the more specialized you were, the better everything was supposed to be. And ultimately, I wanted to shift more into investing. My father had successfully founded a hedge fund business that actually employed all my uncles. So I grew up in the space from a very young age. And the idea was to always move into the family office for our intergenerational transition. And in a sense, I kind of pushed to do that a little bit sooner because I could see what the daily work looked like. All the investors that I was kind of taught and admired and read their books or their biographies, it seemed to me like they all got to do this magical thing all day, which was they got to read, think, talk to some interesting people, read and think some more. And from time to time, it could be while they're reading, it could be while they're in the shower, they maybe have, brilliant idea. And that idea might be productive for 5 years, 15 years, 50 years. You never know. And I really like the idea of being able to have that kind of independence and to think broadly. Obviously, there would be a portfolio and that would lead you into lots of different sectors. So once I was in the family office environment, very happily learning the strategy that we were applying, what started taking place was that families around us who had been successful, been entrepreneurs, built businesses in all sorts of different things, some in financial services, they kept coming to us and they said, we built a fabulous business, it was ultimately sold. And now there's a pile of capital and we've been to advisors, we've been to funds, we've been to planners, we've been to all sorts of handholders with all sorts of different outcomes, some good, some less good, some middling. But what they were struggling to find was some kind of perfect balance of the underlying and how that felt as an investor along the journey. They kept saying to us, what you're doing sounds really interesting. It really sounds like a good fit. Won't you help me? And you hear that enough times from people you really care about, and you feel like the strategy that you have works perfectly to solve that for our family office, had been tried and tested for a long time, felt a need of wanting to help. And so we launched DivGro in 2019.
Yeah, wow. That's such a fascinating insight, and it's almost jumping ahead of where I want to go, but the comment around how it feels, not just the solution itself, the technical component of it, but how it feels to be an investor in that strategy. And I know we will dive into that in a moment, but I wanted to ask, kind of, was the desire always there to follow in your father's footsteps into that world of investment funds?
It's interesting because I remember being 5, 6, 7, 8 years old, and my father was traveling all the time. And so whenever it was school holidays, we would go with wherever he was going. And so I remember vividly in lots of different cities, you might walk past the branch of a local bank and nearby would be a McDonald's. And my dad would teach me that most people, they're kind of banking at the bank and they somehow think of that as an investment. But we own McDonald's and we have a sizable position in McDonald's. And that means you're a business owner. It's not a security that you're renting. These are the reasons why we're in it. Go and stand in the McDonald's and count how many people are there. Go look at the prices on the board. And you make some tiny fraction of a cent on every chip sold, every burger sold, every Coke sold, etc. So it was ingrained in us from a very young age, myself and my sisters, that you want to be a participant in businesses, that you're an investor in that rather than some kind of passive participant. And when you're taught that way, you're not thinking about something as very short term. You're thinking fundamentally. Fast forward 20 years and working in the family office, my father gave me what felt like a really menial task that you might typically think of, you kind of dump on a junior intern. And, and every day I'd go and collect the mail. And we're talking a little while ago, so the mail was this thick. Now it's pretty much all electronic by email. And we'd open the envelopes and you'd have stacks of dividends. Now, it might not mean that much until you understand what was so powerful here, but the task was open it, first check that it arrived from McDonald's or Abbott Labs or MasterCard or whatever the case might have been. Check first that it matches the announced dividend. That's like an accounting function, I guess. And then compare it to the same quarter last year and the year before that. And track that the increase is at the rate that we expect. So we have an objective to compound our capital at what we consider a high but sustainable rate of change. And so internally we use, is the dividend at least 12% higher than this time last year? Now, coming back to feeling, why is this so powerful? Most people experience what the industry has been designed to get you to experience, which is there's the newspaper, there's the pundit, there's the talking heads, there's the brokerage community, the analytical community. They all serve their functions, and not so hidden part of their objective is to create transactions. And you create transactions by changing expectations or changing feelings. And all of these activities were there to ground you as the private owner of these businesses. And we bring that to DivGro. We believe that experiencing changes in dividends and communicating that in a certain way, and we do that in a very innovative way, creates a differentiated experience for the investor. Unfortunately, when we opened the fund at the end of 2019, it was only a few months later that COVID came about.
Yeah.
And our investors told us that even where they own the same security elsewhere, in other funds, in all sorts of mandates, even themselves, they couldn't stand the volatility, what they were reading, and they panic sold all of that. But with DivGro, they were able to stay the journey because they were being, receiving the right kind of feedback. Was the dividend paid? Yes. Was the dividend 10, 12, 15, 20% higher than this time last year? Yes. Feels like a secret language is taking place there. You're on track. We can compress the long term into short term intervals and stay the course to get through the compounding.
Yeah, you can see how that would have helped, because COVID was an unbelievably volatile kind of, 6 months in the stock markets. It feels like it should have been so much longer because it was much more volatile in the world, but the volatility in the stock market was actually quite short, but that ability to ground your investors in this is how we're measuring it, this is what success looks like, rather than the actual capital appreciation or just the pure, this is what's happened to the share price. You can see how that would be a very powerful tool for investors to understand.
Absolutely.
So then jumping into, kind of the dividend side, and dividend investing is typically an approach that most people associate with like high patience, high disciplined, don't give up too early, but it really, really works over the long term. How are you redefining what success looks like in that space? Or is it still mostly this is going to be a long-term play and it's really, really going to work in a 5-year time horizon? How's it working at DivGro?
Very good question. Most people, especially in Australia, when they hear dividend, which is part of our name, DivGro, they immediately think high income. And with us, that's not the case. We're actually not that interested in the income component. What we are trying to do is exploit a relationship that has been proven, documented, illustrated, going back to the late 50s and early 60s at MIT. A trio of professors, 2 of which ended up later winning Nobel Prizes, but spearheaded by Professor Myron Gordon, proved a relationship where if a company is able to pay a dividend and grow that dividend every year, over time, average annual rate of change of the dividend should correspond to the same rate of change in the price. Put simply, if a company can grow its dividend, whatever that dividend yield is today, at let's say 12% a year for the long horizon, you should expect the share price to rise at about that same 12% a year over time. in any given week, quarter, month, year, there might be a gap because the market can become very focused on relatively short-term things or macro things. But over time, the sustained rate of change in dividend and sustained rate of change in price are very much connected. It also makes sense. So what we are looking to do is to find those companies that are able to sustain a high rate of change for a very long time in expectation that the price will respond, and it does respond. And then we take that information and we disseminate it to our investors in a very easy to understand, systematic way whereby every week at the same time on Friday morning, we send a 1-minute email. The email never deals with price. It only deals with this fundamental change. And it goes like this. This week, ADP raised their dividend 10.4%, which is what we wrote on Friday. Before, Visa, 13%. We also received our dividend from Costco and Abbott Labs, both meaningfully higher than this time last year. And then 2 or 3 sentences about what makes one of those companies special, and therefore that this is likely to continue, essentially indefinitely. Now, when you do that, and you build a portfolio of that, and we run typically around 30 companies, we have something to focus your attention in a productive way to give you a better chance to stay with these wonderful compounders for the outer years. And we talk about a model where that we call 30x in 30 years, which is my personal ambition. I hope we get there. We're right on track 6 years in, where if you can compound your dividends at 12% per year for 30 years, and the share price responds at about the same rate, you should get a 30x multiple. Now, we're running on the dividend front at a bit more than 14% per annum per dividend increase. We've never had a decrease, which is wonderful. COVID was a good example. We think that's a peerless record in this category. And so we're right on track. We're trying to raise the probability that people stick around for the outer years. Now, it may sound simplistic, just find those companies and grow their dividend at a high rate. However, if you just go for, say, the dividend aristocrats, which is a title that maybe lots of people know, companies that have grown their dividend for 25 years in a row, or kings, 50 years in a row, that's all in the past. The past was past and the price already responded. What we need to do is find the future. And so we have 120 variables, metrics, data points that we collect around every company. And that educates us. What is the likely trajectory 3, 5, 7, 10 years out for this company's dividend? How likely is it to manifest? And therefore, how comfortable are we with that holding, such that our investors can actually get that benefit. And from an income standpoint, even if the yield is initially low on some of these companies, if you can sustain a dividend growth rate in the mid to high teens for a long time, fast forward, it becomes a torrent of income later.
Interesting. Where which you alluded to, a lot of dividend funds out there are focused on yield today. It sounds like you're much more focused on yield in 5 years. You're looking for that compounding effect on the yield itself.
That's right. Most people are looking for, they begin with what is the highest yielding thing that may not fall over. But if you look at our portfolio, almost every company to the new purchaser today is yielding less than 1%. Many are yielding less than 0.5%. Indeed, some yield less than 0.1%. The dividend is not there because the company is trying to take all of its excess capital and send it out to shareholders. What they are trying to do is take the overwhelming majority of what they earn and reinvest into a wonderful business, or make accretive acquisitions or things like that. Now, the reason why they pay dividends is usually because they are family controlled. There's a controlling shareholder base that these companies appreciate, that they're able to make better long-term capital allocation decisions and to a large extent ignore the quarterly treadmill that Wall Street puts them on if they have a stickier, more resolute, better shareholder base. And if you send out 5, 10, 15, 20% of what you earn out in a dividend that's rising steadily as earnings grow, that shareholder base is happy, more supportive, and is able to look through a quarter or a year, or sometimes 2 or 3 years if there's a significant capital investment taking place, and stick with you for a long time. And when you fast forward, and some of our holdings that we have in our family office, which obviously the fund grew out of, even though they have never yielded more than 1% to the new owner, for us, they're already 50, 80, 100 times the initial yield. because a dividend that is growing at 20% a year after 15, 20, 25 years, well, I encourage listeners to put into their calculator and they'll just see how much income that becomes over time. And it's pushing the share price up at roughly the same rate.
Yeah. Yeah. Yeah, interesting. And so then how did you guys approach, I guess, your investment universe in terms of, are you looking across all sectors? Are you looking across all kind of major indexes? Are you just Australian focused? Are you just US focused? Sort of, what is your investment universe?
So we can't be in many sectors because we need to be in areas that are very predictable and where a company or
Mm,
a small group of companies can basically dominate it indefinitely. So areas that are very cyclical, and that's also a big part of the index in Australia, which is part of why we haven't found something in Australia that we've chosen to own, are
mm,
often very sensitive to the price of iron ore, the price of oil, interest rates, shipping rates, anything that has a very significant bearing on how your business is going to fare that is out of your control
yeah,
doesn't work for us. What we are looking for are incredibly predictable businesses that have a deep installed base where they're providing something very critical that usually is also relatively inexpensive, and therefore it's very hard to undercut them. Ideally, they're also an industry
yeah,
standard and where they have a very long runway of continuing to earn or extract a royalty out of the expansion of that industry. Now, that doesn't mean that we can't be diversified. I actually think we're very we span medical devices,
mm,
span industrials, we span credit rating agencies, payment processors, quick service restaurant franchisors, niche distribution companies, each critical business services, and each one, we believe, provides something that can never be switched off. Often it's being sold to a business. It will essentially be the last cost that business stops paying before it rolls over. It's got a very, very fragmented customer base, such that
yeah,
there's a high degree of pricing power, and these are very predictable and non-cyclical. Now, we prefer to be in the global leader because, as you can hear, we're thinking about a very long-term horizon. And so if you're thinking on an infinite horizon timescale, you sort of have to fast forward very far into the future. And if
mm,
you are participating in a local leader, which is not the global leader, at some point it may exhaust its territory and need to go compete somewhere else, where it might come up against a stronger, deeper pocketed competitor. That means that we
yeah,
tend to be in the companies that are the leaders in the United States. Being the largest
yeah,
economy, they just tend to be the leaders. There are a few
yeah,
areas where a European company might be the leader. For example, in the super luxury goods space, they tend to be
yeah,
European. And we are in that space too. We
mm,
prefer also large companies so that
yeah.
we have the ability to, if we need to change our mind, we can change our mind and sell. So we need to be in liquid names.
Yeah, I was going to say, looking for that liquidity to be able to get in and out. Which that's probably a good point to ask the question. How do you figure out then when to sell? Like, what are those sort of key metrics you're looking for? Understanding the hurdles you've got there for what you're buying into, but sometimes they have a bad quarter, sometimes they have a bad half. Sort of, what's the trigger point you guys are looking at for when you want to sell something?
Really good question. So we actually invert this. And when we build the thesis behind owning something, we start with what information, should it come to light, will completely undermine this thesis so
Mm,
that we don't have to start thinking about this idea becoming undone or reaching its expiration point, though we do own things for a very, very long time, ideally forever, but something can't necessarily grow at a high rate actually forever. So one example might be, and I mentioned the dividend aristocrats earlier, many of the fast-moving consumer goods, personal care companies are on that list. And good examples are Kimberly-Clark and Colgate, both of which were dividend growth
mhm,
juggernauts for decades, two of which we used to own a long time ago in our family
mm,
office. And a very important framework for how they were going to grow their dividend. If you're going to grow your dividend at 15% a year on average, you also need to grow your earnings at roughly the same rate over time. Yes, you might have quarterly fluctuations, but over time. Now, how do you get to 15% a year earnings growth? You need pretty robust sales growth. So let's say sales growth in the order of 10% a year plus a little bit of operating leverage and maybe some capital allocation decisions can take it from 10 to 15. And what we used to see in Colgate for a very long time was, and the same in Kimberly-Clark, was sales growth that was mainly selling more units, more tubes of toothpaste, etc. And a couple percent a year of what they call price mix, adding a green strip, a charcoal strip, a whitening strip, all of the above, and raising the price. Now, what we used to do was check the composition of sales growth and make sure that there was like a 80-20 distribution. 8% growth through selling more stuff to more people and a little bit through this price. And the reason why that's important is if you exploit price a little bit too much and people fall on hard times, and sometimes the economic environment changes and quite a lot of people might fall on hard times. One of the things they may look to change is that kind of personal care item into the home brand. And it's, there's a certain degree of protection with Colgate because it goes in your mouth, and so people are a little bit sensitive about that, and it's more regulated, brand name, etc. But at some point, they might go to the next brand. And what we noticed was that 8 and 2 became 7 and 3, and 6 and 4, and 5 and 5, whereas in some of their competitors, that wasn't the case. It was telling us that they were taking pricing too aggressively, and at some point, they might meaningfully lose share. There aren't more people who are buying this stuff. And to us, that meant that the dividend growth rate will begin to slow down. We don't want to be there for the slowdown of the dividend growth rate, because coming back to the overarching principle, where the dividend grows, the price follows. If the dividend slows from 15% a year to 5% a year, your share price will also go up at about 5% a year. Lo and behold, fast forward a bunch of years, and Colgate has been growing its dividend in the 3 to 6% a year space for the last decade. That's uninteresting to us. So something can reach a point of expiry, which is why this is not a mechanical process. It is an iterative process where you have to be on top of your companies all of the time, so that you avoid the dividend mishaps and can find the dividend kings of the future that are earlier in their trajectory.
So then are you running that kind of model every quarter when the dividends are announced and kind of reassessing the positions each quarter, or is it less frequent than that?
We're actually running it all the time, because what we're doing is we're building what we call our dividend staircase. We're building our dividend staircase because if you chart the trajectory of a dividend, especially in these US-based companies that pay quarterly, they will the typical profile is they pay 4 installments of the same amount. Let's call it $1 per share per quarter. And then they'll raise it typically at the same time of year. Now, what that means is chart that, and you have 4 bars of one number, then up and 4 more bars at a higher rate, etc., etc., etc. If you chart that, it looks like a staircase. Now, we build our dividend staircase out into the future, 3, 5, 7, 10 years into the future. And then we say, how predictable is this business? Do we truly understand this business? Because we need a certain degree of margin of safety, so we can scale that back a little bit. And then we compare where the price is relative to where we think the dividend is likely to go. And when something comes to light, it might be in quarterly earnings, it might be in a presentation at an industry conference, where if information comes to light that changes our expectations over that long-term future of how steep that dividend staircase looks like, or how clear or vague or cloudy that might appear over time, we will change that. We will change our assumptions. And then if they become uninteresting anymore, or we don't have the same degree of comfort or confidence or conviction, we will replace it with something that is on our watch list, on our investable universe, that is more attractive, or change our weightings, which we often do.
And then so typically, or the portfolio at the moment, is that kind of like 100% offshore companies? Have you got anything in Australia in there?
We don't have anything in Australia. That's not for not looking. We do look. It happens to be the case that in Australia, companies are quick to walk away from their dividend. As a general category, there are outliers.
Yeah.
So this is not a hard and fast rule. But many companies here that have a solid or impressive dividend staircase for a period, the moment they hit on hard times, that's it. They sort of capitulate on their
Yeah.
dividend. They break that bond with shareholders. And here there is also a tendency to pay out higher amounts. It's partly because of what the investor base is. It's partly because of the
Yeah.
tax system, not pointing at any
Yep.
one variable, but payout ratios are generally higher. And we're looking for lower payout ratios, more investment. So today we're about 97% in the US or in North America, and then few percent in Europe.
Yeah.
Now the
Yeah. Which makes
quarterly,
sense.
sorry.
I was going to say it makes sense, and because even I didn't realize the consistency in America, that little dividend staircase you talked about, and I was kind of chuckling to myself as you were describing it, going, that just doesn't happen in Australia. Our staircase is this like sawtooth looking thing.
And if you think about habit formation, and what we are trying to do is build better habits. If you have a staircase which genuinely feels like a staircase as opposed to a roller coaster, even if they're
Yeah.
both tracking the same ultimate pathway, one is much easier to stay the course and build better habits. The same way that when people want to get fit, lose weight, whatever endeavor they're trying to achieve, many people might hire a coach or a personal trainer, and it helps you to build a better habit when the trainer is waiting for you at 6 o'clock in the morning at the gym or in the park, as opposed to having to do it yourself. And after a certain period, because you're accountable to somebody else or somebody's holding your hand, it is habit forming. Now, in the case of following the dividend as a proxy for fundamental development of the company, if all you do is focus on the price, look at any company and look at in any calendar year, you'll find usually a big gap between the high and the low every year. That's not because the market is not good at pricing. Over time, it's very good at pricing, but in the short term, it's not necessarily that good at pricing.
Yep.
And so one allows you to build much better habits. We spend a lot of time thinking about psychology, and we built our reporting system or communication system, spending a lot of time with psychologists, psychiatrists, academics in the space. And we're quite strong believers in Alfred Adler or William James and their belief, which is the objective reality is the objective reality. But every person has the capability or the choice of how they choose to perceive it. Now, the facts of what the dividend is, what the share price is, are factual.
Yep.
But how we choose to interpret that is ours to choose. And if you highlight an erratic price, or you highlight a dividend that's moving up and to the right, almost like clockwork, assuming we're doing our work well, one allows an investor a much heightened chance of getting to the outer years, as opposed to being on this rigmarole all the time of looking at the shiniest thing and changing their mind all the time, usually to their detriment.
Yeah. Yeah. Mate, it's a fascinating investment philosophy. It's not one I've heard before, but I'm really intrigued, and one I'd be keen to do some more exploration into. But Jonathan, as we wind up today, I wanted to ask one last question, which is if you could, knowing what you know now, 7 years into DivGro, if you could talk to yourself from 10 years ago, what would be the biggest piece of advice you would give, Jonathan of 10 years ago?
It's a good question. I was very fortunate to be following in my father's footsteps, who also had founded a hedge fund business and grew that successfully. And when I decided I wanted to go and take external money and turn this into a business, he said to me, I very highly recommend that you go and find a partner who will be part of the journey with you, because building any business is a challenging thing. And we discussed before that within a few months of starting was COVID. And, we were only a few months in business. And every business has its ups and downs. And it is much easier to hold hands with your partner and get through the difficult parts than it would be by yourself. And when you're hitting those milestones, just the other day, we celebrated our 200th consecutive dividend increase at more than 14% a year on average. There's so much more when you get to do that with a partner. And so that was fantastic advice to me. And I couldn't recommend it highly enough to anybody else, whatever the business may be. They should consider finding a partner who is intellectually, emotionally, spiritually aligned, in how you're going to work and where
Yeah.
you're going to, because the journey is a difficult one and it's much more enjoyable to do it together.
Yeah, brilliant. Brilliant. Jonathan, thank you so much for your thoughts and insights today. It's been a really fascinating discovery of the DivGro business and the model there, and look forward to watching your success.
Thank you very much, Dan. Very much enjoyed it.